Cypress Development Corp. is developing a world-class lithium resource in the heart of Clayton Valley, Nevada. The size of the resource makes the Clayton Valley project a premier asset with the potential to impact the future of lithium supply. Cypress Development Corp. Trades on the TSX Venture Exchange, symbol CYP, the OTCQB, symbol CYDVF, and on Frankfurt, symbol C1Z1. For more information, please visit our website, cypressdevelopmentcorp.com.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Hilliard Macbeth, author of the second edition of the book, When the Bubble Burst, Surviving the Canadian Real Estate Crash. He's also a portfolio manager and financial advisor in Edmonton. Welcome back to the show, Hilliard.
Nice to be speaking to you.
Hilliard, did the Bank of Canada make any moves on interest rates today?
They held the rate unchanged, and so that's in line with what the U.S. has recently been talking about at the Federal Reserve. But everybody expects the U.S. to cut rates at their meeting, which is in the end of July, so about 2 weeks from now. And the Bank of Canada report today gave a strong hint that they would be looking at cutting rates as well. So even though they, I read through most of the report. There's a monetary policy report that comes out at the same time, and there's a number of contradictory things in there, some good, some bad, but the bottom line seems to be that due to the uncertainties around the global trade, they don't call it a war, but let's call it a global trade war, and other things related to the economy in other countries, not so much in Canada, they're looking to cut the next time they make a move.
Why would they cut interest rates in Canada if the economy here isn't that big of a concern?
It's a great question, and it's actually, that I've got this chart of 5,000 years of interest rates going all the way back to 3,000 BC, and at the beginning of the chart, rates are sort of 5 to 10 to even 20%. At the beginning, they thought 20% was the correct interest rate. It turned out that nobody could pay 20% interest, so after everybody defaulted a couple times, they got more serious, and so if you sort of eyeball the chart over long periods of time, it's generally between 3 to 6%, kind of in that range, maybe 3 to 8%. And even in the Great Depression, they didn't go below 3%. So now we're sitting at basically 1 or 2% or less, and in huge sections of the world, interest rates are actually negative right now. Nothing never happened before in the 5,000-year history. And all anybody's talking about is cutting rates. It doesn't make any sense. Why would they be cutting rates from record low levels going back 5,000 years?
Well, what is cutting rates supposed to do or prevent or cause?
Well, that's the thing. So the idea is that the economy is weak, so therefore we cut interest rates, and that causes the economy to get stronger. But the problem with that is that it doesn't work if housing is not participating. So housing being one of the most important sectors, and of course there's so much debt involved in housing with mortgages, it's traditionally been the sector that leads the U.S. and Canada out of a recession. So they'll cut rates during the recession several times, and then the housing sector turns, and then people can borrow money cheaply. Housing prices are rising, and then the next thing you know, you're in an expansion again. So monetary policy primarily works on items that involve a lot of borrowing by the consumer, because our economies are now mostly consumer spending. So what happened in the U.S. is they kept cutting rates, and the housing sector really has not recovered. I mean, it's come back a little bit. Obviously, it couldn't stay completely dead the way it was in 2009, 2010, but it has not come back anything like what it would have normally in previous cycles. So they call it the transmission mechanism. If the policy transmission mechanism is through the housing sector, and the housing sector is not coming back, then it's not really going to make any difference, because generally, like business people and other people, they don't really make a decision. I mean, imagine you're a group of business people, you're sitting around the boardroom table and you're thinking about spending, $1 billion on a new plant, and somebody checks the interest rate and says, well, what's the interest rate right now? What can we borrow money? Oh, we can borrow at 3%. oh, I don't think we should go ahead. And then somebody comes in through the door and says, hey, the Bank of Canada just cut their rates by 1/4 of a point. And everybody says, oh, okay, now we can go ahead. That doesn't make any sense. Of course they're going to go ahead if they think the project is a good project. And whether the interest rates are 1/4 point lower or higher isn't going to change that decision. But when it comes to housing, when people go to the bank or the mortgage broker to try and qualify for a mortgage loan, then cutting in the mortgage rate can make the difference between qualifying and not qualifying, and that's why traditionally that's been a sector that really goes. By the way, in the U.S., there's still lots of room for the housing sector to get heated up again, because it never really has, even for the last 12 years since the global financial crisis. 10 years since the global financial crisis. However, in Canada, it's not going to work because we're still coming off of a bubble where the correction has been going for a couple of years now. So cutting interest rates can't really work until you get to the bottom of that cycle.
So why would the Bank of Canada then look at that? Do they not consider real estate?
You know, it's interesting you mentioned that, because I looked through the report and I was looking specifically for the housing sector, and now I'm not going to get the wording right, but basically the paraphrase is the correction happened, the changes in the policy were good. Now all the mortgage borrowing is good, and the correction is over, and now we're back on track again. Which is, I think I might have laughed out loud. I was in the food court there, and I was reading it, and I think people probably look at me strangely, but I honestly think I laughed out loud when I read that, because how ridiculous is that? I mean, so the reason that's ridiculous is it isn't going to make any difference. A 10 or whatever the percentage correction is nationwide, I think it's probably 10 or 15% if you look at single family homes. More like 50% in West Van, but that's another story. That isn't going to make enough of a difference so that people could afford to buy a house. And on the other hand, speculators now are all absent, because their only concern is, are prices rising or are they falling? Well, if prices are falling, speculators are not going to go out and borrow way more money than they can afford to borrow to speculate, because they absolutely must be able to sell for a profit, because there's no way they're ever going to be able to repay the loan. So speculators all disappear, housing market stays weak, and then the average person who's buying for shelter, not for speculation, still can't afford the house because the prices haven't come down enough. So it won't be over until prices are quite a bit lower, probably 30, 40, 50% lower than they currently are.
We'll have more with Hilliard Macbeth right after the break.
Aben Resources Limited is a gold exploration company with significant projects in British Columbia and the Yukon, trading on the TSX Venture Exchange, symbol ABN, and the OTCQB, symbol ABNAF. Surrounded by world-class gold deposits and mines, Aben's 23,000 hectares Forest Kerr Gold Project is located in the heart of the Golden Triangle in northwestern BC. For more information, visit us at abenresources.com.
Media recognition from Bloomberg, Reuters, Recycling Trade Publications. Patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMYZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
Welcome back. We're speaking with Hilliard Macbeth. Hilliard, the BC NDP government was smiling when they said home prices in BC have fallen greatly. You've lost a fortune in home equity, and they were happy about it. Have you ever seen a government that was happy that people had lost value in their homes before?
No, I think if they were in government, well, they are in government, aren't they? The
yes.
NDP, I think that's going to backfire on them, because I didn't do a scientific study, but I did a little bit of a survey, and it looks to me like when housing prices are dropping, every incumbent government gets voted out, and because it's the thing that people are most sensitive to is the value of their homes, and they got to blame somebody, so they might as well blame the government. I'm sure it's not the government's fault.
Well, the government is claiming it's because of their 20% foreign buyer tax, the empty home speculation tax, and the so-called education tax on homes worth $3 million and more, that prices have come down. They were smiling when they said it.
Well, they better hope that all the renters, like the younger people, the students, and all that, are really so happy that prices have come down that they're going to go out and vote for them. But the people that have owned homes for a long time probably won't be happy. And maybe the NDP have written that whole sector off, but I don't know how you get elected without the sector of people at home. The home ownership rate in Vancouver is probably close to 70%, 65% probably at the minimum, and those people are much more likely to vote than younger people who might be renting. So it doesn't sound like good politics to me, but who knows? And it kind of reminds me of what the Bank of Canada is saying, is that, well, we took all these measures, and they're talking about the stress test and a few other things that the different government agencies have done, and we solved the problem. And so now all the debt that's being taken on now going forward is going to be good debt. Well, that doesn't eliminate all the bad debt that was taken on for the last 12 years, going back to 13 years now, going back to 2006, when the federal government first brought in zero down payment and 40-year amortization. All of that debt still exists in the system. And in fact, those 40-year mortgages that were taken out in 2006, they still have 27 years left. They aren't even down to the normal 25-year amortization period yet. So those people have paid back very little of the original loan. So all of that debt is still circulating in the economy, and it's still a big risk out there. So maybe going forward, I certainly know from talking to different bankers and stuff that they have tightened up quite a bit. But that doesn't do anything to fix the problem of the people that have too much debt and are looking at housing prices and condo prices that are dropping.
Yes, if you're already paying off a large credit card or line of credit debts, how do you qualify for a new mortgage?
You can't, and the thing is that, the other thing that the Monetary Policy Report, the Bank of Canada, let out today was talking about consumer spending being an area of strength, and I really don't think they are taking into consideration properly the impact of how people feel about their wealth. If their house price is going up and they see their equity going up by $50,000 a year, a lot of Canadians have been borrowing on a HELOC or refinancing their mortgage to spend that money on something, maybe another property, or help their kids buy a house or buy a new car or something. But once house prices, they don't even have to go down. All they have to do is level off. And now that feeling of that extra wealth that can be put to consumption, that disappears. And the consumption also disappears. And those debts, the credit card debts, the auto loan debts, the other debts that are out there, they start to loom much larger. And it's quite common for people, although it hasn't happened for at least 15 years, but it in the past, it's quite common for people when they get to that point to decide as a family, well, I think we're going to concentrate on paying down the debt for a couple of years and get back on track. And if that happens again, then that's really hard on the economy, because that extra debt that's incurred every year, which Steve Keen calls credit, is the main driver of the economy, and it has been for a number of years in countries like Canada and Australia.
We'll have more with Hilliard Macbeth right after the break.
Hi, I'm Douglas Mason, President and CEO of Rainy Mountain Royalty Corp., RMO, on the TSX Venture Exchange. Rainy Mountain Royalty Corp. is a Canadian-based mineral exploration project generator. The company currently holds multiple property interests in Ontario with joint venture partners and is seeking further joint venture partners for other drill-ready properties in our portfolio. For more information, please visit our website at rmroyalty.com or call me at 604-922-2030.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're speaking with Hilliard Macbeth. Hilliard, the latest unemployment stats in Canada showed a loss of 2,200 jobs, which I know statistically is just an eyedropper of stats or people. And the month before that, they said our unemployment was at a record low. Why would they be looking at lowering interest rates to power an economy that seems to be employing as many people as want to work?
Yeah, it's a good question, and actually, coincidentally, the Bank of Canada report came out on the same day that the Federal Reserve Chairman Jay Powell was testifying to Congress. So I was listening to it this morning on Wednesday, and he was asked something similar, and he said, well, so what the question was, it was very usually the questions from the congressmen or women are not that sophisticated, but this one was pretty insightful. It said, you used to consider full employment at when unemployment was at around 5%, and then you changed it to 4.5%, and now unemployment is 3.7%. So are we not at beyond full employment? Sort of like that. And the answer came back and said, well, I think we underestimated how much employment we can get out of the economy. So they were obviously the ability to estimate it is crazy. But the idea that cutting rates might get unemployment from 3.7 down to 3 or 2.5, it just doesn't make any sense, because the old feeling was that when you get to full employment, if you keep cutting rates or boosting the economy by running a deficit, which the U.S., by the way, is also running a huge $1 trillion deficit at the same time, so they're doing both at the same time, you start to push inflation higher. And then you've got a problem, because then you have to raise rates to stop inflation from going higher. And now this hasn't happened since the 1970s. It actually was mentioned in the Bank of Canada report that came out today. And it could be the situation where we get that trade-off, and that's a terrible trade-off. So in Canada, the way it would work is inflation would be rising. The Bank of Canada is facing a weak economy, weak housing market. They would like to cut rates, but they can't cut rates because the dollar is falling. It's currently 76 cents. At that point in that scenario, the dollar would probably be below 70 cents, and the Bank of Canada would be in a position where they have to raise rates in a very weak economy to fight inflation and to stop the dollar from going even lower. Because when the dollar goes lower, of course, that pushes the inflation rate up even higher, because Canada imports a lot of goods, and so the cost of the imports would add to inflation. So the nightmare scenario is where they have to actually raise rates into a weak economy, which we haven't had that as was mentioned since the 1970s. But if they keep going the way they're going, then they might end up in that exact position, and they seem to be aware of it, but they can't help themselves. They still have to cut rates. So if you cut rates when unemployment is at 3.7%, what do you do when a recession comes in and unemployment goes up to 6 or 7%? Do you raise rates then? It just doesn't make any sense at all.
Should they hold off in lowering rates then, so they have some ammo left over if there is a recession?
Well, the rates are so low now, there wouldn't be any ammo. So what up until December, like literally, this is 6 months ago, right? Up until December, that's exactly what they were saying. And not only that, they were saying we're going to have to raise rates. The Bank of Canada was talking about raising rates from 1.75% up to as high as 3 or 3.5%. And the Federal Reserve was talking about doing exactly the same thing. And then on December 24th, some of your listeners might remember this, the stock market dropped, it hit a bottom, and it was down about 19.9%. Didn't quite get to the 20% benchmark where it gets labeled a correction or a bear market. Just shy of that, somewhere around 19%. And then everybody panicked. So the Federal Reserve panicked, the Bank of Canada, everybody panicked, and all of a sudden, instead of talking about raising rates, they started talking about cutting rates. And then we had a couple of weak quarters of economic growth numbers, and now we're on this cutting rate path. But this whole idea that the central banks are responsible for stopping the stock market from having a correction is just insane. Like it's mental illness is what it is. And it started in 1987 with Alan Greenspan in the stock market crash, where the October 1987 the market crashed 20% in one day, and Greenspan panicked and his bosses panicked, and we've been doing this ever since. And it's just all it's doing is just leading to all kinds of problems. Because when they cut rates all the time, you get things like this horrible housing bubble that we have in Canada and Australia, and like the one we had in the U.S. in 2006, 2007 before that crash. So, but they don't seem to be aware of this. So hopefully they're listening to your show so they can find out what they should be doing.
Well, isn't it true the average home buyer doesn't look at how much the house costs or what the interest rates are. They just look at what's my monthly payment.
It's the same with cars and houses, and I think the lenders will probably be. I'm absolutely shocked that this didn't happen after 2009, the global financial crisis. But at some point, the legislation might have to be put in place where somebody has to explain to somebody that if you borrow, $500,000 at 4% interest, you're going to end up paying back, probably close to $800,000 over 25 years. And is that little shack, I don't know what it would be in Burnaby. I was going to say that little shack in Burnaby. Is it really worth $800,000? That's going to be almost all of your excess income for the next 25 years. You're going to have to put towards paying off that mortgage and also the interest on the mortgage. And, if people really looked at it in that respect, they probably just wouldn't go ahead. And then if they didn't go ahead, and if enough of them didn't go ahead, then house prices wouldn't be as ridiculously high as they are.
Well, here in New Westminster on the waterfront, where it's pretty desirable property, we've seen a brand new tower where 500 square foot, one bedrooms, and really saying it's one bedroom's kind of a stretch. They were at $500,000 and now they're below $400,000. Is that pretty typical for across Canada?
The most amazing thing that happened in Vancouver, and so Vancouver single family homes, as you probably know, we talked to, they peaked in 2016. They peaked in July of 2016. But then the most amazing thing happened in Vancouver and to some extent in Toronto as well. Condo prices kept rising, and they rose for another probably 2 years. The price per square foot went from $1,000 a foot to, in some of the new buildings, West Bank is building up to $2,000 per square foot or even higher, and now they're starting to come back down. But how that was possible, given that really the only thing that really goes up in value in the real estate business is the land, not the building, and condos don't have much land under them if they're a high-rise building. How that was possible? I mean, the explanation is that people couldn't afford houses, so they started to just put their down payments down on condos, and the developers were able to keep raising the prices. But that's a disaster that will unfold over a number of years, but it is going to be very painful. Somebody should write a book about the coming condo disaster, but I'm not going to do it.
Well, you've already done surviving the Canadian real estate crash.
I do mention condos in there, and I mentioned what a terrible investment they are, and the reason they're such a terrible investment is just what I was saying, which was when you buy that condo, it's only about 10% of the purchase price goes to the land. The other 90% or so, maybe 85-90%, goes to the cost of the building and the developer's profits and the sales commission and the advertising and all that. And it's sort of like driving a new car off the lot. You get this depreciation that starts right away. It's a little bit more dramatic with a car. The condo building, it goes more slowly, but it's persistent. So 20 years later, the condo the structure itself is old and it needs refurbishing, and the owner's responsible for all that. And there's no way the land can increase fast enough to compensate for that, 2% per year depreciation in the value of the building. So there'd be a lot of disappointed people. But I think a lot of those people that were paying $2,000 per square foot recently in Vancouver and Toronto were doing it to flip. I don't think they were really, in fact, I saw some reports that maybe more than half of them were foreign speculators anyway. But there's bound to be some people in there that thought they were buying an investment, but they're going to be disappointed, unfortunately.
Hilliard, thank you so much for chatting with us.
Nice talking to you, Jim. My
guest has been Hilliard Macbeth, author of the second edition of the book, When the Bubble Burst, Surviving the Canadian Real Estate Crash. His website, macbethgroup.com. If you have any questions for Hilliard or any of our other guests, you can send them to info@housestreet.com. Our YouTube channel, Talk Digital Network. Find us on Twitter @HouseStreet. I'm Jim Goddard. Thank you for listening.
Comments made on HouseStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HouseStreet.com radio is a production of House Street Media Incorporated.